Welcome to this captive review webinar on navigating the hard market alternatives, sponsored by Swiss Re Corporate Solutions. My name is Richard Cutcher, executive producer of the Global Captive podcast and a former editor of Captive Review for 5 years, as many of you may know. We've got a really good lineup of experts who over the next hour are going to discuss and debate the merits and drawbacks of the various solutions corporates can utilize as an alternative to traditional insurance buying. So namely, we're going to kind of examine and debate the single parent captive approach, cell captive options, the virtual captive concept, and perhaps controversially not insuring at all. This discussion is designed to be interactive, and rather than saving 5 or 10 minutes at the end for a Q&A, I'm going to try and weave any questions we have submitted through the hour as we go along. So to submit your questions, please do visit slido.com. There's the information is on your screen there, slido.com, and enter the hashtag captive review. So hashtag captive review. Once you're on Slido, you can submit questions. As I said, I'll try and weave those questions in to a discussion with our experts as we go along. On Slido, there is also a poll we would like you to take part in. It's quite a simple poll. It's just one question, and that question is, in today's hard market, what risk transfer strategy are you most likely to consider or recommend to your client? So it's a question that can be answered by both prospective captive owners or consultants, insurers, captive managers, brokers. Have a look at that, and please do submit your answer, and we'll try and visit that at the end if we can, just to kind of reflect on that very briefly. Okay, well, let's introduce our 4 expert speakers today. We've got all the bases covered, I think. So from Swiss Re, we have Thomas Keist, Global Captive Solutions Leader at Swiss Re Corporate Solutions. Providing a client perspective, we have Mark Dawson, Head of Insurance at Dyson and also Chair of AMIC's Insurance Steering Group, so very experienced on all things insurance, particularly in the UK market amongst corporate insurance buyers. We also have our actuarial expert for the next hour, excuse me, Stefan Swanepoel, founder and principal consultant at Directrix Risk Services. I'm very jealous of Stefan as he's down in Johannesburg, South Africa at the moment. And providing a broker and captive management view is Benjamin Jacobs, senior consultant at Aon Global Risk Consulting in Switzerland. So we're going to come to each of these guys in turn over the next few minutes. But Mark, I thought it would be really good to start off with yourself and to find out, as an insurance buyer, what are your observations of the market currently, and how are corporates looking to mitigate and tackle what is quite a difficult market?
Yeah, thanks, Richard, and afternoon and morning, everybody. There's no doubt that we're in a hard market, and many corporate insurance buyers have seen the effects of this during their 2020 renewals in terms of, firstly, significant increase in rates and premium. And in the cases of D&O, increases several 100% are not uncommon for listed companies. There's been reduced capacity and carriers withdrawing from certain lines of business, increased retentions, stricter underwriting criteria is being applied. This is backed by sort of insurers requesting additional information. Corporate buyers are seeing reduced policy limits being either imposed or available. Restrictions on policy coverage, exclusions being applied. I think one of the frustrations is that underwriters are having to refer decisions to their head office, which is taking longer to get decisions made, and as a consequence, renewal terms are being communicated late in the day to buyers, which obviously causes issues. Let's not forget claims. I mean, I think the hard market, we're seeing sort of greater scrutiny of claims. So, as you can just see in that sort of quick roundup, significant changes have happened sort of late on last year and really through the whole of 2020. I think in terms of how a corporate sort of tackling this, there's a number of steps that buyers are taking. These include obviously starting the renewal process earlier, providing more information to insurers. So I think a lot of buyers understand that that there is a requirement or need to provide information. So by getting that process started early, it allows them time to be able to source that information and provide it in a timely manner. Buyers are reviewing their program structures, reviewing limits, retentions, coverage. I think it's also here just it's important to work out what's important to retain in terms of coverage and what you might be able to give up. So it's a question of trade-offs. And as I say, a lot of additional coverage extensions might have crept in the soft market, which might not be so relevant today. Nice to have, but not necessary. So those can probably sort of traded. Clearly, I think conducting remarketing activities create competition is very apparent. And interestingly, AMIC, which is the UK's trade association, which represents large corporate insurance buyers, in their recent pulse survey, their Q3 pulse survey, it said actually two-thirds of member company risk managers were exploring the use of alternative risk financing mechanisms such as captive and parametric solutions. And likewise, the Marsh Captive Landscape Report of 2020 mentions that 89 new captives have been established up to September, which is an increase of over 150% on prior year. And existing owners are also making much more use of their captives. So I think in terms of as we sort of come to the end of 2020 and sort of look into next year, I think we can really expect that trend to continue with more captive formations. Captives also increasing their retention, so existing captives increasing their corporate retentions, and also expanding the lines of insurance written by a captive. And so all of this is really sort of a response to the prevailing hardening market. So sort of back to you, really, Richard.
Yeah, cheers for that, Mark. Really nice introduction to set this conversation up. And you mentioned there that Marsh report, and that's important to mention that often a lot of captive formations happen in the second half of the year, and that was just for the first half of the year. So I think those numbers are going to go up quite considerably, and I think we'll see a lot more activity next year too. Thomas, as an insurer and partner of captive owners, what's kind of your assessment of this market and the appetite for more exploration of alternative risk transfer solutions, some of which we'll come on to it in a bit more detail in a bit?
Yes, thanks. So, I mean, we talked about the fact that it is a hard market. Now, I think what is actually, timely is that over the past 20 plus years, the market for alternative risk transfer solutions has developed tremendously, and in that sense, especially the captives. So the captive as a alternative risk transfer tool has been established, is widely known now and widely accepted, and also regulated in a way that makes it really a safe place to start thinking about alternative risk transfer solutions. So what we do see is a tremendous uptake, obviously, and we of course are very keen to see new formations of captives, because from a insurance point of view, it's always a very good thing to work with sophisticated clients. And the sophisticated clients are those who have captives, and with that very well established risk management organization. In addition, I would say what we do see is that the questions go beyond. So if you are a corporate client and think about your increased retentions and possibly self-insurance vehicles, you start to think beyond the captives, because there are in the meantime also alternatives. So it's fair to look at all of them. And I think that's also why we are here today, to a little bit contemplate the various options that corporate clients have these days. And that's why I'm looking forward to this discussion here.
Yeah, okay. Well, let's get into some of the drivers of self-insurance and some of the ways that it can be structured. Ben, in a hard market, as we've just heard, we hear a lot about existing captives expanding their programs, taking on more risk, whether that's taking on more capacity in existing lines or adding newer lines. One of the drivers of this is corporates looking to take higher retentions to combat rate increases and a shortage in capacity. What are the advantages in principle to self-insuring, whether that's formally or informally, these high deductibles?
Right. Yeah, and Richard, I believe, this really needs to be answered also in the context of the current market situation and also different lines. Yeah. So an example, for PDBI, currently we are seeing, especially for critical industries that are more in focus here for increased rates and capacity shortfalls. An example as the chemical industry, partially pharma, recycling industry, meat industry. We are simply seeing that currently insured primary layers are no longer insurable, and hence corporates are forced to take significantly increased retentions, and often then, you do have the situation that you do have smaller business units that simply don't have the balance sheet strengths to take these increased deductibles. An example, 10, 20, maybe even 50 million. And then, the captive is not so much about cost management, but really about providing a cover for that risk gap between the risk-bearing capacity of smaller entities that are within your group and obviously need some sort of balance sheet protection, and then the new higher entry attachment point, for the risk transfer. And this can be also then different for other lines. So motivation, an example for liability. For liability now we are also seeing substantial rate increases, but then introducing an example, a captive to have or to finance increased retentions. This is then often more with the cost rationale, so total cost of risk and reducing that. And then for liability, obviously, then having the captive and is having then the additional advantage that you still can issue then also certificates, which is critical, for liability. And then lastly, give me one maybe also another interesting example, which is pretty new for D&O. In the current renewal, we are really seeing that we do have tremendous shortfalls in D&O capacity, especially for clients that are under financial distress, and are highly indebted, and they simply, 50% of capacity is just breaking up now. And what we are seeing here is that, an example, by providing a mechanism that clients can take the first 10, 20 million and finance them on their own, that you can unlock over proportional capacity in mid and excess layers, and the captive can be the solution to that. So in a nutshell, to sum this up, there are various advantages. It can be like for D&O, increase of capacity. It can be management of the total cost of risk as for liability, or simply covering uninsurable parts as partially for PDBI.
One question we've just had in from the audience already, which I'm gonna give to you, Ben, is a kind of a follow-up from what we've just been discussing. And if you do want to submit your questions, please do go to slido.com, #captive review. Bottom left of your screen, you'll see the address there and the hashtag. Ben, we've had a question. It says, if I do increase my captive retention, does it make sense to protect the captive's balance sheet by using a structured solution? I presume they mean a structured reinsurance solution. Can you talk to that briefly?
Absolutely, there's no straightforward, clear answer to that. It's a trade-off. Yeah, I mean, obviously you do have to review the solvency position overall of your captive and see, I mean, how this is impacting overall capital requirements. So what's the incremental impact here on your capital requirements by adding more risk, and what does it mean? Yeah, do you have enough risk-bearing capacity in the capital in your captive to finance that? If not, then obviously you do have to find another solution, and then instead of injecting more capital, a good reinsurance solution can be an answer. Yeah, so again, this is all about capital management for the captive, and to get this right, I mean, it's important first of all to see what are the drivers, what's the impact, and what's the most efficient way to manage this.
All right, fantastic. So let's go through the kind of the three key structures we're going to try and get into now, which is standalone, traditional, single parent captive, cell captive, virtual captive. Stefan, I'm going to come to you first on this, and I want to ask Mark for some additional comment afterwards. As an experienced operator of the traditional captive approach, the single parent captive, what would be your argument in favor of using a standalone single parent captive insurance vehicle to self-insure these retentions we've just been discussing?
Well, I think to add on to what Ben had to say, there's two parts to the question. The first part of the question is, are you going to self-insure or are you going to retain? And then once you've decided to self-insure, are you going to do it through a captive or not? On the single biggest advantage of a standalone captive, it's fairly straightforward. It's flexibility. You're in charge of your own mini insurer. That obviously, unfortunately, brings the disadvantages of cost, complexity, administrative burden, things that go with it. But obviously, many of the domiciles have services that provide a lot of the or reduce a lot of the burden on the parent company. But I think what's more important is to decide whether you want to self-insure or not, and are you doing it for the right reason. Then the captive will be a natural consequence of that process and that structuring. So it is extremely important to understand what you're trying to achieve, going back to what Benjamin said as well, because typically retention is by far the most efficient way to retain risk actuarially. There's no frictional cost, there's nobody telling you what to do with it, there's no solvency requirement, but unfortunately you can't do that if your balance sheet can't handle it. Whereas a captive obviously allows you to create a different balance sheet that operates to different rules, and especially in a favorable domicile that allows that. So singularly, I would say a standalone captive is definitely not a one-size-fits-all approach to all companies. You have to have a certain amount of critical mass, and if you have that critical mass and it makes sense from a cost perspective, then flexibility is definitely the single biggest advantage of a single parent captive.
Yeah, Mark?
Yes, I mean, I sort of very much support what Stefan has said. I mean, in my experience, larger organizations, that's larger corporates, tend to prefer the single parent captive or pure captive arrangement. Generally, as a decision to set up a captive is a longer term strategic decision, which forms part of an organization's overall risk management and risk financing strategy. And I think so they're not just doing it in terms of a short term reaction to a hardening market. It is this sort of longer term strategy. And I think the large corporates prefer it because they feel, one, it gives greater control. Captive is a subsidiary of the parent. Flexibility, as Stefan mentioned, in the choice of domiciles, also around the selection of managers, directors, actuaries, auditors. More control over the governance of the captive, so directly can control that governance as opposed to leaving it to a third party. Coverages also can be tailored to meet the parent company's needs, and a really good point here is that you can incubate new lines of insurance in your captive, and I think also really importantly, broader access to reinsurance markets through your single parent captive. So I think all in all, those tend to be the main reasons why the larger corporates tend to go down that single parent captive route in terms of their main preference.
Yeah, so I want to move on to cell captives next. I'm just going to tee up though. We've had 2 questions in, just wanting us to expand a little bit on the D&O theme. It is such a hot topic at the moment, and I'm going to come back to D&O. We will come back to that specifically. And Mark, I'll probably put you on the spot on the D&O question a bit later. And Benjamin, I'm sure you'll have some views on D&O as well. In the meantime, though, I've given Mark some time to prepare himself there. In the meantime, though, Ben, let's get into cell captives a bit more. And look, cell captives is a term that describes a lot of things, right? There's about 1,000 different names for cell captives: PCCs, ICCs, SACs, SPCs, sponsored, LLCs, even. I'm not going to talk about all of those. Let's focus more on the kind of protected cell company concept that most of us know a bit better. I think it's fair to say that cell companies have never been more sophisticated now than they have. They've never been more sophisticated than they are now. Sorry, and many captive managers offer these facilities in a variety of domiciles, both onshore and offshore. If a corporate does not already have a captive in place, what would be the attraction of renting a cell from an Aon or someone else to kind of get them started?
Right. Okay. Just to make sure that, people in the audience know what we are talking about, right? So protected cell companies are effectively, this is an insurance facility that you are renting from a third-party provider. It's a specific legislation put up, an example in the European Union that's available in Malta. The specialty is, it is not your specific legal entity. It's part of the legal entity of the insurance company, of the provider, and you are simply renting one part of that. And the specialty about this is that by the nature of the legislation, assets and liabilities are legally segregated. One of the, from my point of view, or out of my client experience, one of the most important implications is because it is not your legal entity, you also cannot retain any risk finally there. So the difference between the limit, the annual aggregate limit, in example, and the premium, the risk gap needs to be, you have to put some collateral behind this. Whether this is reinsurance, parental guarantee, letter of credit, performance bonds, you name it. But just also to avoid spillover effects from one cell to the other, you do have to put collateral behind this now. So that's basically what we are talking about compared to a fully fledged captive setup. An example, as Mark is running it, it comes at substantial. It's substantially easier to operate and run, because obviously all the legislation and also the regulatory requirements, especially under Solvency II, are a bit lighter if you simply have one part of that and not fully own the insurance company. So operational ease is clearly one. Second, because it's not your insurance company, then typically, or in many cases, you are using the regulatory capital of the insurance company. So you don't have to put additional capitalization upfront into the vehicle. So typically you are having then a lower net working capital or capital employed, so to speak. And depending on the domicile, you are sometimes a bit faster with the overall setup. So that's are the key advantages of it. However, right, also depending on the domicile, I think Stefan, you will comment on this as well, right? There are certain legal and tax aspects to be considered, which are clearly linked also to the local requirements. So clearly, to make sure that this is working also from a tax and audit point of view, you really should review this with your legal and your tax function in your corporate organization.
Yeah, thanks that Ben, and yeah, Stefan, I will bring you in on this in terms of obstacles or disadvantages to using a cell captive. Could you kind of elaborate on some of those for us?
Well, Benjamin's been nice enough to shorten my answer quite a bit. He did raise couple of the things. But I think put it in simple terms, you don't really have underwriting capacity in a cell. South Africa is a very different cell environment to the European Union, but we have similar requirements in terms of equivalence with reinsurance. We have similar requirements in terms of balance sheet requirements. Here we do tend to capitalize ourselves. They're actually bought and they do consolidate into the accounts of the parent. But there are many variations on the theme. But the biggest obstacle we encounter with this kind of structures, by the time a client comes to you and say they want X million, say 5 million of capacity, you say, well, that's going to cost you 5 million. And they're trying to typically get away from a premium increase of 50, 60%. That takes them to a, say, 18% rate online, which is quite expensive. But at the same time, that's nowhere near what you have to put down in a cell captive to alleviate that requirement for risk cover. So I would say that, especially for the smaller companies, the biggest obstacle is the risk gap is much smaller between your premium you have to pay in or resources committed in some form or another, and the cover you can actually write. And then downstream complications of things, it's not yours. There will be rules. There will be a core cell that will decide how you will do certain things. They will invest money in, obviously, certain assets. There will be certain currency restrictions, country restrictions. So all of those will typically create it's a less flexible environment, effectively putting it one step down on the pecking order of sophistication and flexibility from a standalone captive.
I think, yeah, that's really helpful, Stefan. And we've had another question from the audience, which I think is a really good one, actually, an important one to answer. And I could ask it to any of you, but I'm going to start off with Stefan, as you had your last answer shortened. So I'll put you on the spot with this one. But the question is, and we've got no name on the where the questions come from, and that's fine. But the question is the establishment of a captive a bit of an overreaction to a hard market phase, given that there can be other viable alternatives to try and mitigate the hard market? What would be your kind of response to that question if establishing a captive because of a hard market is an overreaction?
It preempts one of the topics that I was planning on raising later on. I do find any interest in risk finance tends to be, and risk finance being the entire sphere or universe of these kinds of products, they tend to be very knee-jerk. You have a hard market, you have a bad renewal, anything goes wrong in the program, they suddenly want to start up a captive, and that's where the issue comes in, that you are limited to what you can put away effectively. So yes, there tends to be an overreaction in a difficult environment, but I also think if you do your homework right, you structure the program right, and you build capacity and resources over time, it is a long-term strategy that will always be better than insuring, because you have more funds dedicated towards risk in a captive environment than you have dedicated towards risk in a insurance environment. It's a simple fact of how the premiums are put together. So yes, there are very, very few risk finance programs that work and make sense on a one-year basis. You need to be in it for the medium to long term for it to make sense.
Yeah, I mean, maybe, Richard, if I can add, right? I mean, what we are seeing here is that, or at least, I mean, the expectation from Aon is that the hardening market is to stay. So we'll see this also for the upcoming renewals. And now, I mean, the key question to every one of us is: are we having enough flexibilities and options to offer alternative setups? In example, if I'm facing partial uninsurability of the primary layer, if I'm facing substantial rate increases, what will I do? Do I have options? What can I do, or do I simply have to take the hit? And as part of that question, I mean, a captive setup can be the answer, not necessarily, but I mean, it's important that everyone has clarity on strategic options and flexibility. I think that's key here.
Yeah, just to add, Richard, sorry, just to add there, I think, if we go back, sort of through recent history, but in every hard market cycle, and appreciate, we haven't had one for a long time, sort of a decade and a half at least, prior to this one. But if you go through sort of in terms of the 1980s hard market, the 90s, sort of after World Trade Center in the early 2000s, all those changing market situations accelerated the rate of new captive formation. So that is the history. So this is nothing new. It's just the fact that we haven't actually had a hard market for a long time. There's been an abundance of capacity. Capacity has been relatively inexpensive, and that's why corporates have been able to make those decisions around, well, how much do we put into a captive versus actually how much can we transfer to the market. And when it's actually inexpensive to transfer to the market and there's abundance of capacity, then that's a choice they make. Obviously, when that is not the case, that's actually when the captive comes into play. So I think that's all we're seeing at the moment. It's just in line with what we've seen historically.
Yeah, I was going to come to you anyway, Mark, for that kind of buyer's perspective. I have had some communication with some other captive consultants. I won't embarrass them by naming them, but I feel like there is certainly a lot of I told you so type of attitudes for people who have maybe conducted feasibility studies for captives a year ago or 2 or 3 years ago, and they didn't pull the trigger because it was a soft market, and they would have liked to have done that 2 or 3 years ago because they would have had the captive in place to react rather than having to react in a so-called knee-jerk reaction now, because you've got to understand that the captive is obviously a long-term play to kind of have it in place. All right, well, Thomas, let's just move this. We've got loads more questions coming in, and I am going to try and get to them all. But Thomas, I want to just move this on. Whatever structure a corporate does choose, if the captive vehicle is self-insuring increased retentions, would its insurance partners have the comfort to apply an appropriate discount to the premium for that remaining traditional insurance program above the new kind of self-insured layer, if that makes sense?
Yes, it does make sense. Absolutely. It's actually, I think Ben would agree to that. Very often, this is at the end of the day the reason why maybe the step to implement the feasibility study made and basically maybe build a captive or enter a PCC agreement is not happening, because the market above the retention that you introduce with your captive or PCC or whatever, the market is not really discounting the premium above enough to be able to give you the freedom of self or risk finance, self-financing this additional retention. Now, why is this happening? This is because, of course, many of the insurers in the market, they have been suffering from underwriting losses over now quite some years, and they're trying to recover, and they also don't want to let go this opportunity. That's why they very often are very conservative when it's about giving discounts to increased retention levels. However, and this is, I think, very important, again, it goes back to what I think all of us said, you have to take a little bit more of a longer term view. These are strategic considerations. You can't do knee-jerk for these things. And in the longer run, what happens when you introduce a new retention level and finance it by way of a captive, PCC, virtual captive, whatever, you gain independence in the long run. So this is part of the flexibility that was mentioned. It's part of the argument Mark brought up with respect to access to reinsurance markets. Longer term, you gain independence. And whilst you might suffer from being stuck with an insurer for maybe another year because there's just not enough time to exchange or to go for another option, in the longer run, you will have the independence to look for a better opportunity, a better alternative for the excess of loss insurance, if you like. And this is something that you definitely need to keep in mind: independence.
So if Mark, if the insurer doesn't apply those kind of appropriate discounts to the premium if the captive has done its bit in terms of increasing its retentions? Does the entire concept of that higher self-insured retention is that delegitimized at that point? Is there other benefits to it? How disappointed would you be if you didn't get that kind of reward for kind of putting your money where your mouth is, so to speak, because the captive's got so much skin in the game?
Yes, I mean, ordinarily, Richard, I would expect to receive a discount for increasing the size of the retention. I mean, I think that's most corporate buyers would say that. Having sort of said that, though, trying to sort of see it from both sides and see it from the carrier side for a moment, there are a number of factors that an insurer needs to consider in agreeing to provide a discount, and obviously Thomas has just sort of touched on that to some extent. But I suppose first of all, the size of retention needs to be taken into account. So what is the size of retention or retention increase that the buyer is actually looking to take versus the capacity that the insurer is providing? So I think that's a sort of one area. Also the likelihood of loss. So I can perhaps understand that an insurer may be less willing to provide a discount on cat risk, because these are low frequency but high severity claims. So and essentially that the premium is based on that. And in terms of loss history, I mean, I think if the buyer can demonstrate that a retention removes a significant portion of losses from an insurer, so particularly around high frequency, low severity claims, then I would be expecting a discount to be provided there, because you are actually removing risk and that dollar swapping with a carrier. And I'd also sort of say, let's not forget the role of the broker here. It is very important in terms of working with the insurer to provide that justification for a discount. And that requires good loss analysis, good loss forecasting data. So the likes of Ben and Stefan from an actuarial standpoint, they've got a good role to play here in being able to obviously provide the ammunition to the insurer to be able to make that justification for a discount. But in summary, I would expect a discount to be negotiated of some size.
There you go, insurers. You've heard it from Mark. That's what he's expecting in next year's renewals. Stefan, what's your viewpoint on that from the actuarial perspective? What would you be, what would you kind of be advising or expecting to see?
My short answer is the insurers will never give you the discount you want or the discount you feel you deserve. But I think conversely, the reality is the insurer tends to rate on some form of pooling and averages. And on self-insurance, you tend to look at things on an individual risk or individual internal profile basis. But that is where the actuarial structuring of the program becomes extremely important. And we regularly sit with a situation where we actually calculate the change in the cost of risk to the client if they were to increase deductibles or to the market. And we expect a discount in that range, but you get, if you're lucky, 40, 50, 60% of that. We refer to it as premium drag. And that doesn't invalidate the sum. It just makes your discounted payback period for their investment into risk finance to make sense over a period of time. If you got the discount you're hoping for, maybe you can get it to make sense in 3 years. If you don't get your premium drag to 60%, it makes sense in 5 years. It doesn't invalidate the argument simply because of your 100% of premium paid, such a high proportion of your premium is dedicated toward risk and risk finance, as opposed to a commercial insurance market where there's profit requirements and other solvency requirements. So it doesn't invalidate it. It just, you need to be very clear on what your cost of risk is, and will the higher retention serve you better even if you receive a smaller discount than expected. I think the mantra, the underlying mantra with this kind of thing is that risk finance only makes sense if you are of a better risk profile than the market is willing to give you credit for, allowing for elements such as premium drag and profit allowances in commercial premiums. But yes, it doesn't invalidate it. It just makes it a bit more careful planning requirement.
So Ben, should the nuclear option ever be considered, which is do nothing and don't buy any insurance at all? I mean, obviously there are some things you do legally have to buy insurance for, so let's put that aside. But for things where you have got a choice, is just not buying insurance an option?
Well, absolutely, right. I mean, when you consider your strategic options, I mean that could be at least partially the answer. This is not about not insuring at all, but more about an example of retaining the first 10, 20, or 50 million of risk. So effectively the primary layer that in a captive case would have been shifted to a captive simply on the balance sheet, right? And as Stefan outlined at the very beginning, from an actuarial point, in many cases, it's the cheapest way. Yeah, it's really the cheapest way to finance it, because you are saving all the frictional costs. Yeah, I mean, just to give you one example, you know, I have a German background. You know, in Germany, the IPT is 19%. You have 5% fronting, roughly 2% captive administration costs. So overall, what I'm saying, if you compare the captive with the balance sheet as risk wrappers, you have 26% of frictional costs between a captive case and a balance sheet case. So, I mean, that's a strong argument, financially seen, yeah, to retain risks at least partially on the balance sheet. Yeah, but however, as already shortly discussed, this is only the pure financial point of view. Yeah, you do have to consider also the corporate governance and the compliance background of it, because in example, right, I mean, if you are simply not insuring the primary layer as an example, yeah, then each named insured, each business unit on its own needs to finance its own risk. Because I mean, if you establish then some sort of risk pooling arrangement and financing mechanism in your balance sheet, I mean, simply the tax auditor, yeah, will typically see this, you know, as an insurance mechanism on your balance sheet, and hence this will be challenged. So now, are your named insured all in a position to finance the primary layer on their own single entity balance sheets? Maybe yes, maybe no. So what I'm saying is not insuring at all, I mean, can be from a financial point of view a compelling business case, but also to get this done, I mean, you need to work with your internal controlling finance guys, with your internal tax guys, to validate more in a sort of as if scenario, is that really feasible for us? Yeah. Another one is an example for liability. I mean, if you do have public sector clients, you might need a certificate. Yeah. So if you're not insuring the primary layer, yeah, maybe simply you cannot provide the certificate and you cannot run tender. So you're seeing what I'm saying. Financially, yes, in many cases the best option, but also that needs a thorough elaboration from a compliance and corporate governance point of view, from a sales distribution point of view, to make sure that you really have a 360 assessment of all your requirements. So simply, and in some cases, simply it's not possible. Yeah. Yeah. And then I mean, also the captive, and then the captive is not only having the captive is not only a tool to optimize total cost of risk, but then also the captive is having another function, yeah, which is then really providing a compliant framework.
Well, thank you for that, Ben. I think that's been useful to outline kind of some of those considerations if you were to consider the kind of uninsured approach. Thomas, one of the other options that certainly has been talked about a lot the last 12 months, and you and I did did a webinar for EMIC on this exact topic earlier this year, is the virtual captive concept or virtual captive approach. Could you briefly just explain for us in a nutshell, so to speak, what is the thinking behind the virtual captive and how does it work?
Yes, I think I can do it in the meantime. I can do it in one sentence, basically. I talked about it so much. So what we're trying to do as Swiss Re with our Swiss Re balance sheet is, by way of a structured insurance agreement, we try to emulate the financial mechanics of a captive just on our balance sheet. So in other words, because our interaction with a client is by way of an insurance agreement, that's the only way we have to interact. We use that instrument, but we structure it such that the self-insurance dimensions of the intention comes to fruit. And typically you basically achieve that by way of introducing structural elements like additional premium and return premium or low claims bonus. And this way you basically manage the cash flow such that at the end of the day a large part of the risk is self-financed by the corporate client.
And can a contractual agreement effectively replicate the benefits of a captive, do you think? Thomas, did you get that question from me? I think Thomas might have just lost me, or someone's lost me. But I will.
Yeah. I mean, Richard, right? I mean, just to step in here for Thomas. Yeah, I mean, definitely, right? I mean, the virtual captive setup to a certain degree. I mean, it can give you effectively also that sort of financing, yeah, that we discussed. I mean, effectively to bridge the gap and provide an example balance sheet protection, or to issue a certificate, right? I mean, it's exactly these compliant points that we already discussed that typically would be covered by captive can also be provided by a virtual captive setup. Yeah, so an example, if a balance sheet retention doesn't work for you and you don't want to set up a captive for whatever reasons, because you're simply believing that the hardening market is only here for 1 or 2 years, whatever, then I mean the virtual captive setup, I mean, could be a step in between, because you're fulfilling these requirements without setting up and running a captive.
Yeah, thank you for that, Ben. Thomas, are you back with us? Can you hear me?
I think I'm back. Yes, I'm back.
Perfect. Well, Ben stepped in for you just there on how the virtual captive can provide this same benefits with a contractual agreement. I just want to ask a question to Stefan, and maybe Thomas, you can add on to it as well. Stefan, does the cell captive know, if we're talking there about potentially a virtual captive being a stepping stone into a single parent captive, does the cell captive not remain the better alternative to a virtual captive, given that the argument that a virtual captive can be seen sometimes as a cash trap by the financial services community? Is there concerns there for you, and how does it compare to a cell captive as kind of a doorway into a single parent?
I think that the cell captives and the virtual captive, by way of their structuring, operate on completely different bases. Going back to the original commentary, that your underwriting capacity in a cell captive is limited to what you have put in there or have committed to it, whereas the virtual captive blends access to the balance sheet of Swiss Re, which obviously is quite significant, with a portion of self-funded risk, which basically gives you a dial you can move between how much you want to transfer and how much you want to retain within certain limits. So I think it speaks to a very specific niche. We have similar structures in South Africa that are far simpler and less flexible to this, but having the ability to year on year move the needle between how much do you want to transfer and how much do you want to retain, I don't see that being a cash trap. I mean, the only view of cash trap between captive and cell captive and virtual captives for me would be investment income, and that I've never seen investment income to be a defining difference between these. It's a sweetener that helps you absorb expenses. It's not really the reason why you get into self-insurance. The investment income is generally quite low on these because of the assets you tend to commit to. So I don't see the cash trap being solely focused on the virtual captive as much as risk finance in general. But at the same time, I believe the virtual captive is a very specific blending product, which is not possible through a cell captive structure.
Is it?
Unless obviously reinsurance excluded. I mean but that's a very formal contract. This is an internal contract.
Is it, Thomas, is it possible that a virtual captive, obviously lots of captive formation activity at the moment. I've been doing a lot of research recently on who are forming captives, and there's some quite big, interesting companies out there currently forming captives or just formed captives this year. And one group of those is kind of large conglomerates with many kind of different companies within them. Is a virtual captive, is that easier to implement, do you think, for us as a self-insurance vehicle compared to pure captives for large conglomerates of that type, where they might have lots of different business entities within them?
Yes, absolutely. That's exactly the case, right? At the end of the day, a virtual captive is an insurance agreement, and you basically you have less resistance within a company, especially if it's large and complex, to introduce new legal entities, separate legal entities with a different business purpose than the core business of the company. You don't have that because it's an insurance agreement. It's something everybody understands, also a CFO understands it. And the other piece of it is that, management tends not to be keen to commit for a long period, right, on something that is new and is different, and maybe it's not clear how it really works. And with a virtual captive, which is a multi-year insurance agreement, you have an option to exit again after 3 years or maybe 4 years or 5 years. You can exit again, and relatively easily. So I think these are the key points, especially when talking about large complex corporations and conglomerates. It's easier to implement, to get the approvals for that. It also doesn't need a long-term commitment initially, and therefore it can especially used if you think about the virtual captive as a stepping stone to maybe a real captive.
So what I want to do, we've got 8 minutes left. We've got a few more questions that have come in. I want to try and get through as many as possible. We probably won't get to all of them. I am going to finish on a question about timelines to Ben and Thomas about how long, if you want to set up a single parent captive, if you decide you want to do it today, how long is it going to take to set up? Same for a cell, same for a virtual captive. But before that, I did promise our audience we come back to the D&O topic, because it did produce quite a reaction when Benjamin and Mark both touched on it early on. Mark, we discussed D&O quite a bit actually in our captive special interest group at AIRMIC this year, because it is such a distressed market and corporates are looking for alternatives. A couple of the questions that we had come in were kind of asking about conflicts of interest. What is the view of adding D&O to a captive? Let's take side B and C separately, and then we can address side A separately, because they're quite different. From your view, Mark, and from what you've heard from peers, how comfortable are people with the idea of taking side B and C into their captive?
Yes, I think first of all, need to look in terms of what is the motivation of putting D&O into captive, because traditionally, D&O has generally been outside of the captive. But what this hard market is doing is, for some corporates, just D&O market or D&O insurance, sorry, or limits is just not obtainable. So it's not a question of at a price, it's actually not available to them. So I think in terms of if we split out the side A and the B and C, the B and C represent obviously the corporate risk, the corporate reimbursement, the securities risk, and I think that can go into a captive. I know there's some question marks around conflict of interest, because at the end of the day, a pure captive or a single parent captive is a subsidiary of the parent, and should that subsidiary if it's, I suppose, pressure is exerted on it to pay claims. But you could say the same on any other lines. I think certainly for side A, people view this as more of conflict of interest, because obviously side A is there to indemnify directors when the parent organisation can't or isn't prepared to indemnify. So I think if it is a subsidiary of a parent who is indemnifying those directors, then that potentially does bring into conflicts of interest. So I think for pure captives, probably side A is in my opinion, is fraught with some problems. Having said that, I think in terms of a PCC for side A is more arm's length, because it's not managed. It's managed by third parties. So potentially that, as a more arm's length arrangement, that could be maybe a better alternative. But yeah, I think you need to think about it very carefully.
Yeah, and Mark, fully agree here to your points. And I mean, more as a background observation, well, what we're seeing here is that obviously also in many top management contracts, certain sums insured are guaranteed, and obviously the expectations from top managers are that coverage is provided more or less ground up to make sure that personal wealth is fully protected. Yeah, especially if if you are under a distressed financial situation overall. Yeah, and then I mean, if you're here in a market environment where you effectively can unlock over proportional capacities more in the mid and high excess area, if you take a certain retention, then I mean obviously it makes sense for the corporate to consider options and to find a way to manage the conflicts of interest, to make sure that maybe you are taking the first 10 or 20 million, finding another insurance mechanism, and then unlocking say 60 or 80 million additional capacity in the excess area. So that's the case. So overall, that's to the benefit for all stakeholders effectively. Yeah.
Okay, I'm going to squeeze one more question in before we get into timelines. Thomas, one more question on the virtual captive approach. Can a virtual captive create proof of risk transfer issues, especially if it's been fully secured by the insured? So are there any proof of risk transfer issues that the virtual captive can come up against? Oh, you're on mute, I think, Thomas.
So second piece first, there is no need for collateralization in case of a virtual captive arrangement. So there is it's not comparable to a PCC where you have to collateralize the risk gap. There is no such thing. So, and then to the first piece, whenever we structure a insurance solution like a virtual captive, we always make sure it passes all relevant tests, including risk transfer tests. So that and there are several, and they are known, and we don't need to go into them in detail. But essentially, the answer is no. And in addition, actually, by working with a I would think reputable company like Swiss Re, you also have some credibility behind the arm's length pricing of such a product, which makes it, which is an advantage, I think.
Great. Okay. Well, as I said, I'm very, very sorry for people's questions that haven't got asked. We have had lots, some quite cheeky ones as well, including why we don't see the likes of Aon promoting virtual captives. I don't know if you want to quickly comment on that, Ben. You seem like a cheeky person. You might want to answer it.
It's not true. Really, I mean, we are looking for our clients on the full spectrum of risk wrappers, actually including balance sheet financing. Yeah, I mean, just to be very clear here. So this is really, I mean, the full spectrum, and that's also in the background that especially, I mean, for the clients, I mean, for that do have the size for captives. I mean, typically, I mean, these are often fee-based accounts for us nowadays. So, I mean, also from a financial point of view, there's no conflict of interest for us. And that's the reason why also for content-wise, but also financially, right? I mean, there's no reason why we shouldn't look into all options.
Great. Okay, so we are over time, but we're going to talk about time very quickly. So, Benjamin, I'm a prospective captive owner. I've done a feasibility study, so the feasibility study is done, and I want to set up a single parent captive. I know it's going to vary by domicile to a degree, but how quick can a single parent captive get set up?
Yeah, really. I mean, it takes time, even if you hurry up. Yeah. So typically, I mean, 3 months feasibility study, especially if you have actuaries on board, also to do loss forecasting and program structuring exercises, plus 3 months for the setup. So that gives you 6 months. Plus, I mean, even if you're under pressure, my experience is that you need 3 months for internal decision processes, even if you're fast. So probably, I mean, it's fair to say 9 months is realistic. Yeah. Also, I mean, for the other options, I mean, just to be very clear, even if you retain it on the balance sheet, right? I mean, we discussed it. I mean, you need time to clarify certain issues in-house in your organization. So even for that option, probably you need 3 to 4 months to really talk this through with the corporate functions and make sure that this is working. So regardless what you're doing, I mean, you need proper time to make sure all stakeholders are on board.
And cell captive, is that comparable?
I mean, for cells, typically, I mean, if it's in the European Union, as for Malta, an example, I mean, you also have now, due to Solvency II, 3 months regulatory phase. So overall, I mean, the feasibility study and the decision process might be a bit shorter, but the implementation time is more or less the same.
I haven't quite read up on the intricacies of it yet, and my friends in Guernsey will not forgive me for that. But I did see something in Guernsey about a kind of a pre-approval process for cells now. So that's something to look up if you are interested in going offshore outside of the EU. I'm not sure. Ben's putting a face there. Thomas, yes. On the virtual captive side, do you come across the same obstacles and time restrictions as Ben outlined on the single parent and cell approach?
No, the main time restriction is actually internal loops. So still people need to be gotten on board. So accounting, tax, legal, management. These loops, but they are in the hands of the buyer. With respect to setting it up, it's a structured insurance agreement. As soon as we have the relevant normal underwriting information at hand, we can be quite quick. It tends to take a bit longer if an international program is involved, which we take over as a leader, and it takes a bit longer. All the other options we have for implementation, you know, we talk weeks, maybe a month, something like that.
Great. Well, the 5 of us could continue this conversation for another half an hour, but that is our allotted time. Thank you to our 4 panelists. Thank you for all your insight and being quite reactive with the questions we've had in. And also, thank you to everyone who's tuned in as well. We had great attendance. So thank you for joining us, and thank you for being so interactive. Enjoy the rest of your it's rainy here, rainy Thursday. Thank you. Bye-bye.
Thank you. Bye.